What separates a successful trader from an unsuccessful one? It's more than just strategy and mindset. Enter the risk-to-reward ratio, a crucial component of every trader's routine. This is not just a fancy term, but a key to unlocking consistent profits in the world of trading. The risk-to-reward ratio measures the potential returns of an investment against the risk of loss. Think of it as a scale, balancing the amount you are willing to risk with the profits you aim to make. This ratio is pivotal in defining the viability of a trade. It helps you decide whether a trade is worth pursuing or not. Now, you might be wondering why it's so important. Well, without a clear understanding and application of the risk-to-reward ratio, no trader can truly be successful. It's as simple as that. So buckle up as we dive deeper into this essential trading concept. Let's delve deeper into what exactly the risk-to-reward ratio is. This critical measure helps traders quantify their expected gains against their potential losses in each trade they make. The risk-to-reward ratio, often abbreviated as RR ratio, is a key tool in any trader's arsenal, helping them make calculated decisions about their trading strategy. So how do you calculate this ratio? It's quite simple. You divide the distance from your entry point to your stop-loss level by the distance from your entry point to your take-profit level. The stop-loss level is the point at which you decide to cut your losses and exit the trade, while the take-profit level is where you plan to exit the trade with a profit. Let's say you've identified a potential trading opportunity. You decide that your stop-loss level is 10 pips below your entry point, while your take-profit level is 30 pips above your entry point. In this case, your risk-to-reward ratio would be 1:3 or 1:3. This means for every pip you're risking, you're aiming to gain 3 pips in return. But remember, trading is not just about chasing the highest possible returns. It's also about managing your risks effectively. The RR ratio is a powerful tool that helps you do just that. It enables you to assess the potential risk involved in a trade relative to the potential profit. The bigger the potential loss, the worse it is for a trader. Why so? Well, trading is inherently unpredictable. Even the most experienced traders have bad days where they make a series of losing trades. A large RR ratio could lead to significant losses in such scenarios. This is why the risk-to-reward ratio is a critical aspect of any successful trading strategy. It provides a clear framework to evaluate each trade, helping you make informed decisions about when to enter and exit a trade. Remember, successful trading is not just about making profits, but also about minimizing losses, and the risk-to-reward ratio is a key tool in achieving this balance. Now that we understand what the risk-to-reward ratio is, how does it actually work? At its core, the risk-to-reward ratio measures how much you could potentially earn for every dollar you put at risk. It's a way of quantifying your potential gains against the potential losses. Think of it as a scale, balancing the potential reward on one side and the risk on the other. One of the most popular ratios used by traders is the 1:3 ratio. This means that for every dollar risked, there's the potential to earn $3. In other words, the potential reward is 3 times the amount you're willing to put at risk. But it's not just about the numbers. The ratio represents a mindset, a philosophy if you will, that emphasizes the importance of managing risk above all else. Now, you may wonder, how does one manage this ratio effectively? The answer lies in the use of stop losses and take profits. These are preset levels at which you decide to close your position, either to prevent further losses or to lock in your profits. By using these tools, you're essentially setting the boundaries for your risk-to-reward ratio. You're telling the market, this is how much I'm willing to lose, and this is how much I aim to gain. But remember, the risk-to-reward ratio is not a magic bullet. It's not a guarantee of profits. It's a tool, a guide that can help you make more informed decisions. It's about making sure that the potential reward justifies the risk. It's about ensuring that you're not just trading for the sake of trading, but that each trade you make has a purpose, a potential benefit that outweighs the potential loss. And the most important part, the risk-to-reward ratio helps ensure that you never risk more than you're prepared to lose. It's a safety net, a safeguard against the unpredictable nature of the markets. Because in trading, as in life, it's not just about the rewards, it's about managing the risks, so that you can live to trade another day. The risk-to-reward ratio isn't just a number, it's a crucial tool for successful trading. This tool plays a pivotal role in calculating potential losses and profits, ultimately influencing your trading decisions. Its importance is not to be underestimated. Imagine the risk-to-reward ratio as your personal financial compass, guiding you through the volatile seas of trading. Just as a ship's captain must know the depth of the waters before dropping anchor, you, as a trader, should understand your risk tolerance for each trade. It's about asking yourself the hard questions. How much can I afford to lose in this particular trade? How much am I willing to risk today before I decide to call it quits? Don't be fooled into thinking that there's a one-size-fits-all risk-to-reward ratio. Quite the contrary. Your risk-to-reward ratio should be as unique as your trading strategy, tailored to your individual risk tolerance and market expectations. Sometimes a trade might look enticing due to promising price formations, a favorable economic background, or maybe it's just your gut feeling telling you to jump in. In these instances, it might be tempting to take on more risk, adjusting your risk-to-reward ratio to 1, 2, 1, 1, or even as low as 1, 0.5. And that's okay, as long as you comprehend why you're entering the trade and can keep your emotions in check. However, remember that a smaller risk-to-reward ratio doesn't necessarily mean a higher chance of profit. Market volatility can be a cruel mistress, quickly turning a seemingly profitable trade into a losing one. This is where finding a balance between your risk-to-reward ratio and the win rate of your trade becomes paramount. Trading isn't about gambling your funds away. It's about making educated decisions based on a thorough understanding of your risk tolerance and potential profit. And that's where the risk-to-reward ratio shines, acting as a beacon in the often murky waters of trading, guiding you towards informed, intelligent decisions. The risk-to-reward ratio is more than just a number. It's a guide to intelligent, informed trading, and that makes all the difference between success and failure. So, we've taken a deep dive into the concept of the risk-to-reward ratio. We've understood that it is a measure of the expected income and losses in investments and trades, enabling traders to define the amount of money they are willing to risk and aim to gain in each trade. It's calculated by dividing the distance from your entry point to stop loss by the distance from your entry point to take profit levels. We've also seen how it works, measuring how many dollars you could earn for each dollar you risk. Remember, it's not about sticking to a universal ratio, but rather assessing each trade individually, considering factors such as market volatility and your own risk tolerance. Importantly, we've realized that the risk-to-reward ratio is a vital aspect of every successful trading strategy. Remember, understanding the risk-to-reward ratio is a critical step on the path to successful trading. Use it wisely and see the difference it can make to your trading outcomes.